History doesn't repeat, but financial patterns do, and today's story exposes a hidden money mechanism that has shaped global power for centuries. Because what happened in 1929 is still influencing global finance today, and almost no one knows the real story behind it. We're sitting in stage 5 right now, and that's not speculation. That's just looking at what the numbers tell us. History has a way of rhyming with itself, and when it does, you're looking at about 18 months before things fall apart completely. Think about 1929 for a second, from when the people who actually knew what was happening started getting out, all the way to when the Dow tanked 89% of its value. It took exactly 18 months. You can trace it month by month because the mechanics don't change. They never do. September 1929 is when Stage 5 kicked off. Markets were at their peak. Everyone thought it would go on forever. Behind closed doors, the insiders were selling quietly. Margin debt was at 8% of GDP. Stock prices had completely separated from what the companies actually earned. The math made what came next inevitable. October 1929 brought the first crack, the initial wave of forced selling. Then, November and December, happened false rallies, bounces that fooled people into thinking it was over. January through June 1930 was this slow, grinding descent. July to December 1930, things started accelerating downward. By January 1931 through March, capitulation. 18 months later, in March 1931, the Dow had dropped from 381 all the way to 160. That's a 58% hit, but hold on, that wasn't even the absolute bottom. 2 years after that, it hit 41, an 89% total collapse. But here's what matters. Those 18 months, that's when the real damage happened. When money disappeared, when the middle class got wiped out. Fast forward to November 2025, we're standing at the exact same moment September 1929 was in. The signals. Identical, insiders are bailing out at record pace. Margin debt is closing in on that 8% GDP level. Warren Buffett's sitting on $325 billion in cash. Stock valuations don't make any sense. The smart money has already moved out, so we're starting that same 18-month countdown right now. If the pattern holds, and historically it always does, we're looking at May 2027 as the 18-month mark. That's when most of the money transfers from people forced to sell to people who position themselves to buy. I want to walk you through what went down month by month from September 1929 to March 1931. Then, I'll put that same timeline over 2025 to 2027. Show you which months matter, when selling accelerates, when false hope shows up, when people finally break. Most importantly, when you need to make moves if you're actually going to come through this intact. Because the crash isn't one single day. It's not Black Tuesday and then done. It's 18 months of systematic money destruction happening all around you. And right now, the clock started ticking. September 3rd, 1929. The peak. Nobody recognizes the Dow Jones closes at 381.17. To the average person on the street, this number represents the infinite genius of the American economy. It's the highest it's ever been. It won't get back to that level for 25 long, painful years. But on that Tuesday in September, nobody is paying attention to the cliff edge. The financial press is euphoric. Brokers are not just selling stocks, they are selling a lifestyle. They are telling factory workers, teachers, and farmers to mortgage their homes to buy more stocks. Irving Fisher, basically America's best-known economist at the time, is out there giving interviews, talking about this permanently high plateau for markets. He is the voice of authority, assuring the public that the old rules of gravity no longer apply. But while Fisher is talking, the architects of the market are silently leaving the building. Joseph Kennedy, the father of a future president and one of the decade's most ruthless moneymakers, is liquidating everything. He isn't just selling a little. He is exiting the market entirely. Why? Because of a conversation he had with a shoeshine boy. The legend goes that when the boy polishing his shoes started giving him stock tips, Kennedy knew the game was over. When the last buyer has entered the market, when the people with the least information are gambling with borrowed money, there's no one left to buy. Kennedy gets the math that the public ignores. He knows that when everyone is buying stocks on 10% margin, meaning they only put down $10 to buy $100 worth of stock, the system is rigged for a collapse. If prices fall just 10%, the buyer's equity is wiped out instantly. Once equity is gone, the broker makes a margin call. They force the sell-off to cover the loan. This forced selling drives prices down further, triggering more margin calls for other people. It snowballs. It's a nuclear chain reaction of liquidation. Once the lever starts pulling, nothing stops it until all that borrowed money is paid back or wiped out. Bernard Baruch is another titan who sees the storm. He has already moved his massive fortune into cash and government bonds. He's been through this before the panic of 1907. He recognizes the pattern, the obsessive conversations at dinner parties, the religious belief that stocks only go up, the way people get angry if you suggest caution. It is a psychological sickness that infects the masses right before the fever breaks. And it's not just individuals. Smart money from Europe is flowing out. British banks, sensing the instability, have been quietly dumping American stocks since August. They remember the South Sea bubble of 1720. They remember the railway speculation mania of the 1840s. They know a universal truth. When valuations completely break from actual business reality, when people are buying symbols on a ticker tape rather than shares in a business, that is the most dangerous spot on earth. The corporate betrayal. Here is the data point that history books often miss. Corporate insiders in 1929 were dumping stocks in massive volume while publicly cheering for the market. This wasn't portfolio rebalancing. This wasn't tax planning. This was systematic liquidation. Company leaders, board members, the people who saw the weekly sales reports were dropping 50, 60, 70% of their holdings. Why? Because they knew the dirty secret of 1929. The economy had already turned. Earnings for corporations peaked in Q2, 1929. By September, they were sliding. Factory orders were falling, manufacturing output down, commodity prices were weakening. The real economy, the one of steel, wheat, and rail, was already contracting, but stock prices kept climbing. This gap, this divergence between reality and fantasy, is the signature of Stage 5, the mirror image. November 2025. This is exactly where we stand today. Look at the numbers. The Dow and S&P are trading at or just below all-time records. The AI hype has convinced the world that productivity will infinite, justifying any valuation. But look at Warren Buffett. He is holding more cash than he ever has in the history of Berkshire Hathaway, $325 billion. He isn't buying the dip. He isn't buying the hype. He is doing exactly what Bernard Baruch did in 1929. He is moving to safety. Company insiders are selling at levels we haven't seen since 2007. Right before the global financial crisis, margin debt is approaching those record-breaking percentages of GDP. But today, it's not just margin debt. It's zero DTE options, 0 days to expiration. It's massive leverage hidden in the shadow banking system. The mechanism is the same. Borrowed money pushing prices up, creating a fragile tower that only needs a breeze to topple. September 1929 was Stage 5. November 2025 is Stage 5. The smart money has left, the retail public is holding the bag, and the 18-month countdown just started. October 1929. When things feel different, in 1929, October didn't start with a crash. It started with unease. The market became volatile, violent swings up and down, up one day, down the next. But the trading volume was massive. The ticker tape, the technology of the time, couldn't keep up. It was running hours late. People didn't even know what price they were trading at. This is the distribution phase where the last of the insiders offload their shares to the desperate outsiders who still believe October 18th, a Friday, saw a big sell-off. It bounced back by closing time, But something shifted in the air. The smell of fear arrived. The following Monday, more selling pressure. Tuesday brought heavy volume and dropping prices. By Wednesday, panic was setting in. That afternoon, a scene played out that feels like a movie script. A group of major bankers met at J.P. Morgan's offices at 23 Wall Street. Thomas Lamont, Albert Wiggin, Charles Mitchell, the titans of the era. They announced they were forming a fund to stabilize things. They walked onto the floor of the exchange and placed massive buy orders for U.S. steel above the market price. It was a show of force. The market rallied. Over the weekend, the papers celebrated. Bankers save market. The scare is over. But sitting in mailboxes across the country over that weekend were thousands of margin calls. The bankers could buy stock, but they couldn't pay the debts of millions of ordinary Americans. The break Monday, October 28th, Black Monday, arrived. The bankers didn't step in this time. The dam broke. The Dow dropped 13% in a single day. Then Tuesday, October 29th, Black Tuesday, the day that defined a generation, 16 million shares traded hands. The ticker ran 4 hours late. Traders were collapsing on the floor from exhaustion. The Dow fell another 12%. In 48 hours, a quarter of the market's value vanished. But here's the thing people miss, and this is crucial for you to understand. This wasn't the end. This wasn't the Great Depression. This was just the initial break. This was the moment leverage started getting pulled out of the system. The forecast, November 2025 to December 2025. Based on how this pattern works, somewhere in the next 30 to 60 days from right now, we'll see our version of this break. It might not be a Black Tuesday in a single day because we have circuit breakers now that halt trading, but the result will be the same. It could be triggered by a major bank going under, perhaps a commercial real estate lender collapsing under the weight of empty office buildings. It could be a major tech company missing earnings catastrophically, revealing the AI bubble has popped. It could be a geopolitical shock in the Middle East or Asia. It doesn't matter what the trigger is just the pin. The bubble is already there. Watch for this sequence. First comes a sharp single-day drop, 3% to 5%, unusual but not unprecedented. The plunge protection team, our modern version of the 1929 bankers, will try to talk it up. Next day, there's a rally, then another drop. Bigger this time, 5% to 8%. Then the big one hits, 10% to 15% over a week. That's the break. When you see it, understand this isn't the bottom. This is month 1 of 18. The most dangerous illusion. After the initial selling wave of October 1929, something strange happened. Prices stabilized. From early November through December, things bounced. The Dow was down 30% from its peak, but it held there. It even rallied significantly in early 1930. Why? Because human psychology struggles to accept a paradigm shift. People thought the worst had happened. The media narrative shifted. It was a healthy purge. The speculators are washed out. Stocks are fairly priced now. Advisors told their clients to buy the dip. It's the oldest lie in finance. Some people did buy. Stocks were 30% cheaper. It felt like a bargain. This is technically called a dead cat bounce. It is one of the most dangerous moments in financial history because it creates false hope. People holding losses think if they just hang on, they'll recover. People who sold at the top think they should get back in to catch the rebound. But underneath the surface of the stock market, the real economy was beginning to rot. Banks were sitting on losses they weren't showing yet. The loans they made for stock purchases those borrowers couldn't pay back. Banks were quietly absorbing the hit, tightening up what they lent to protect themselves. Businesses started feeling the credit squeeze. Orders dropped. Layoffs started in the industrial heartland. By December 1929, joblessness was rising. Not crazy amounts yet, but noticeable. The modern trap. December 2025, January 2026. We will see this exact phase in December 2025 and January 2026. After the initial crash, there will be a stabilization period. The Dow might recover 10 to 15% from the lows. Financial media CNBC, Bloomberg will declare the bottom is in. They will trot out the CEOs saying, "Our balance sheet is strong." Analysts will push strong buy ratings. Retail investors on Reddit and X, formerly Twitter, will tell each other that this is the opportunity of a lifetime. Some will believe it. They will leverage up to buy the dip. They will be wrong. What's really happening behind the scenes in early 2026 will be the tightening of the credit noose. Banks will stop lending to small businesses, construction projects will halt, the soft landing narrative will die, a quiet death. This stabilization play is a trap. It is months 2 and 3 of your 18-month countdown. People buying here thinking they're getting bargains will see their money cut in half over the next 12 months. The water torture of finance. January 1930 arrived with the market down roughly 35% from its peak. It didn't feel like the end of the world anymore, more like just a bad hangover. People were hopeful that 1930 would be a recovery year. Even President Hoover said, "Prosperity is just around the corner." It wasn't. From January to June 1930, the market didn't crash. It ground downward. It was like Chinese water torture. February, another 5% lower. March drops 3%. April bounces 2%, giving a flicker of hope. Then May falls 7%. June falls 10%. Relentless, the psychological damage of this phase is far worse than the initial crash. In a crash, adrenaline takes over. In a grind, despair takes over. Every time you think it's found a floor, the floor gives way. Economic indicators kept deteriorating. Unemployment in 1929 was 3%. By mid-1930, it hit 8%. Factory output was down 20%. Commodity prices were tanking, destroying the farmers in the Midwest. Tea put was down 20%. Commodity prices were tanking, destroying the farmers in the Midwest. Companies that were still running were slashing pay to avoid layoffs, meaning workers had less money to spend, which hurt other businesses. And then the banks started failing. Not the major New York banks yet, but the regional institutions. In the first half of 1930 alone, over 600 banks shut down. Remember, there was no FDIC insurance then. If your bank failed, your life savings were gone, vaporized. This caused panic in local communities. People with bank deposits started withdrawing everything, putting cash under mattresses. But here's the banking trap. When enough people pull their money at once, even a healthy bank fails. They don't keep that much cash in the vault. By June 1930, the Dow sat at 220, down 42% from the peak. People were starting to get it. This wasn't just a correction, it was a structural collapse. The 2026 parallel. The slow bleed. This is months 4 through 9. January through June 2026, based on the current timeline, the market will grind lower, every month new lows, every bounce failing. You will see unemployment climbing from 4% up to 7%, then to 10%. Major companies will announce not just layoffs, but restructuring, a polite word for firing 20% of their workforce. The Federal Reserve will panic. They will cut rates to zero. They might restart QE, quantitative easing, printing money in massive amounts. And this is the scary part, it won't work, because the problem isn't a lack of liquidity. The problem is a solvency crisis. When every balance sheet is damaged, when nobody wants to borrow because they're already drowning in debt, monetary stimulus is like pushing on a string. By June 2026, the market will likely be down 50 to 60% from the peak. Trillions in market value erased. Most retail investors are still holding, still hoping, paralyzed by the sunk cost fallacy. They've watched their 401s cut in half, watched their net worth disappear, and they are mentally shattered. They are just waiting for Phase 4. July 1930 rolls around. 9 months of grinding decline has worn everyone down. Then, gravity takes over completely. July. The Dow falls 15%. August. another 12%, September, 18%. It's not a grind anymore, it's a free fall. What happens here is capitulation. This is the moment when the person who swore they would never sell, who held through the crash and the grind, finally snaps. They can't take the pain anymore. They sell at any price just to stop the bleeding. Mutual funds face redemption requests and have to sell. Hedge funds blow up and have to sell. By November 1930, the Dow is at 180, down 53% from the peak. But the cycle demands blood. December brings another brutal sell-off. The holiday season of 1930 was one of the darkest in American history. Stores were empty. Banks were failing in waves. Over 1,000 banks failed in 1930 total. In countless communities, the local economy simply ceased to function. No credit, no cash, no jobs. January 1931. Unemployment hits 15%. 1 in 6 workers has no job. Industrial output is down 30% from peak. Steel mills running at 30% capacity. This is when the Hoovervilles started appearing shanty towns on the edges of cities where former middle-class families lived in shacks made of scrap metal. The wealth transfers 18 months later. In March 1931, the Dow reaches 160. That is a 58% decline from the peak. The absolute bottom would come later in 1932 at 89% down, but the bulk of the wealth transfer happened in this first 18-month window. By March 1931, the weak hands were empty. The forced sellers were done. And who was buying? The titans, Joseph Kennedy, who got out in 1929, started buying aggressively in late 1930 and 1931. He was buying solid companies for pennies on the dollar, the Rockefellers, the Mellons, the Getty family. They weren't buying at the top, they were buying amidst the ruins. This is the brutal truth of capitalism. Generational wealth is not built by riding bubbles up. It is built by having cash when bubbles burst. The future. July 2026. March 2027. This is what our future looks like. Acceleration and capitulation. Unemployment hitting 12 to 15%. Corporate bankruptcy surging. Major companies' names you think are too big to fail will file for Chapter 11. Remember Sears? Remember Kodak? It happens. Banks will fail in clusters. The FDIC has about $130 billion in its insurance fund, but insured deposits top $10 trillion. If 2% or 3% of banks fail, that fund is depleted. The government will have to step in, printing trillions, which will lead to a currency crisis on top of a deflationary depression. Social unrest will explode. Protests, strikes, demands for radical political change. By March 2027, 18 months from today, the wealth transfer will be complete. Assets will have moved from the middle class to the ultra-wealthy. Right now, November 2025, we are at the September 1929 moment. The signals are screaming at us. Signal 1. Insider liquidation. In the last 6 months, insider sales have beaten buys by a ratio of 20 to 1. They are running for the exits. Signal 2. Buffett's cash, $325 billion. He is betting on a crash. He is betting against the U.S. economy in the short term. Signal 3. Valuation extremes. The Shiller P/E ratio is at 35. It has only been this high 3 times. 1929, 2000, and now both previous times ended in catastrophe. Signal 4. The divergence. The stock market is at highs, but the real economy, manufacturing, shipping, real wages, is rolling over. This divergence never lasts. Reality always wins. What you must do. The 4-phase battle plan. You have 18 months. This is not a time for fear. It is a time for execution. Phase 1, November to December 2025. DE risk. This is your last clear exit. If your portfolio is 80 to 90% stocks, you are exposed. Cut it to 50% or less. Take profits. Move into short-term U.S. Treasuries, T-bills, or gold. Gold is historically the hedge against chaos. T-bills give you yield while you wait. Sell the speculative garbage now. If it doesn't make a profit, sell it. If it's a meme coin, sell it. In 1929, speculative stocks went to zero. They didn't come back. Consider puts. Buying put options on the SPY or QQQ is like buying fire insurance on your house while the forest next door is burning. If the market crashes 50%, a small 2% position in puts can explode in value, offsetting your losses in other areas. Phase 2, January 2026. Ignore the noise. When the market bounces after the first crash, do not buy. Repeat this to yourself. It is a trap. Use any rally to sell whatever you couldn't sell in Phase 1. Do not listen to the TV pundits. They are paid to keep you in the market. Phase 3, Feb to June 2026. Stay the course. This is the hardest part. Doing nothing, you will sit in cash while the world burns. You will feel pressure to do something. Don't let the market grind. Let the leverage unwind. You are preserving your ammunition for the final battle. Phase 4, July 2026 to March 2027. The attack. This is where fortunes are made. When the market is down 60 to 70%. When headlines say, the end of capitalism. When your friends are selling in panic, that is when you deploy your cash. You don't go all in at once. You scale in, you buy the companies that cannot go bankrupt, the monopolies, the essential services, the strongest balance sheets. You buy them at 1931 valuations. People who bought in 2009 made 500% returns in the next decade. People who buy in 2027 will set their families up for the 2040s and 50s. The math doesn't lie. 18 months from stage 5 to when most wealth gets destroyed. September 1929 to March 1931. We're at the September 1929 moment right now in November 2025. That means March 2027 is the 18-month mark when the market falls 60 to 70%, when most retail investors lose most of their money. When the transfer finishes, this isn't prophecy. It's pattern recognition, same signals, same stage, same math, and math doesn't care about optimism, hope, or belief. It just runs its course. You can see this coming, or you can get blindsided. You can position yourself on the right side of the transfer or the wrong side. You can be the person with cash buying at 50% off, or the person forced to sell at 50% off. The choice is yours, but the clock is running. If this video helped you see what's actually coming, subscribe right now, because over the next 18 months, I'll be tracking this pattern month by month, showing you where we are in the timeline, what signals to watch for, when to make moves. You don't want to miss those updates. They could be the difference between surviving this crash and getting destroyed by it. Subscribe now, and if you want deeper analysis, specific stocks, exact timing, professional level strategies, join as a channel member. Links below. 18 months from now, the pattern says most of the damage will be done. The question is whether you'll have survived it or been destroyed by it. I'll see you on the other side.